Hi everyone, I'm Alice Yu, Senior Analyst from Metals and Mining Research at S&P Global Market Intelligence. I'm based in Beijing and it is my pleasure to be joining the conference today via video. Back in the spring, when I was submitting presentation topic for the session, it was a matter of will lithium and cobalt price recoveries hold? 10 months on, prices have risen from strength to strength. Now the question is really, where will the price momentum head? And I hope to shed light on this question during the presentation. S&P Global Market Intelligence is the world's leading provider of end-to-end intelligence on the mining sector, with an unrivaled industry database covering all aspects of the mining value chain, from exploration through to M&A and corporate financials, as well as proprietary by commodity forecast and mine cost analysis. We'll start off by looking at the plug-in electric vehicles or PEV market. This includes pure battery electric vehicles, BEVs, and plug-in hybrid EVs. Global PEV sales have been constrained by the chip shortage since middle of this year. In October, passenger PEV sales for the top markets dipped 4% month over month, as sales declines in Europe outweighed increases in China and the US. The general consensus is that the worst of the chip shortage is now over, but the shortage is likely to persist well into next year. Typically, Q4 is the strongest quarter of global PEV sales. We believe this is and will still be the case, but the EU is unlikely to repeat its strong Q4 sales performance last year, which accounted for 45% of the full year total. We anticipate global passenger PEV sales to rise 112% year over year to 6.5 million units this year, led by China as it returns to the top spot. Downside risks include an unexpected worsening shortage of chips, computer chips, and further power rationing in China affecting PEV production and its supply chain. Policy support has been instrumental in the shift toward electromobility. In the US, the passing of the infrastructure bill brings long-awaited positive news after months of debates, with $7.5 billion towards the rollout of EV charging infrastructure. And US lawmakers in the Senate are also progressing with Build Back Better bill, which, if passed, could provide a more imminent support to PEV sales. The bill proposes raising the EV tax credit to $12,500 per vehicle, which is $5,000 more than currently. The proposed new credit could also become refundable on the portion exceeding a buyer's tax bill. And there could also be further policy upsides from the EU, as well as possibly China, including detailed legislative text for Fit for 55, which sets out a higher reduction in fleet-wide carbon emissions for 2030. China's passenger PEV penetration rate has averaged 19% between August and October, approaching the 20% target set for all PEVs by 2025. There are early discussions of raising the 2025 target to 25 to 30%, which, if implemented, will provide greater policy direction for the country's EV uptake trajectory. We expect China and Europe to continue leading global passenger PEV sales at a 38% CAGR growth over the next 5 years, reaching more than 15 million units of sales by 2025, supported by policy incentives, broader model offering, and wider consumer acceptance. Now, battery metal prices have risen sharply this year. Lithium prices are up 139% year to the end of October. Cobalt and nickel prices have increased 86% and 18% respectively year to November the 22nd. We do cover the nickel market, but for today, I'll mostly focus on lithium and cobalt. Right now, we're seeing severe tightness in the lithium market as producers are not able to expand fast enough to meet surging demand this year due to capex and production pullback last year. For cobalt, low operating efficiency at Port of Durban in South Africa, which is the most important port for global cobalt trade, continues limiting supply availability to end users. Now the global shipping bottleneck is deepening the tightness across both metal markets, with a shortage of containers and vessels and higher freight fees, raising costs and supporting higher metal prices. Taking into account aggregated impact of the price increases, the battery metal costs for lithium iron phosphate or LFP batteries have increased 385% in October compared with 12 months ago. And nickel manganese cobalt or NMC batteries, their costs are up 98 to 114% over the same period. The choice of battery technology is crucial in determining metals demand, and there are two clear trends. Firstly, the LFP chemistry is gaining stronger traction because it has lower battery metals costs. Part of the reason is that it contains no cobalt, which is the most expensive cathode metal. And cobalt supply is also highly concentrated, causing concerns from a supply risk mitigation perspective. The LFP battery is popular, especially in vehicles offering low to end drive range. The LFP share in China's lithium-ion battery production rose from 43% in January to 63% in October. And the second trend is the shift toward more nickel-intensive batteries. And this is due to nickel being relatively cheaper than cobalt and its ability to increase battery density and subsequently vehicle range. We expect the share of nickel-intensive batteries, those with 8 parts of nickel and above in global passenger BEVs, to increase from 26% to 41% between 2020 and 25. And the corresponding LFP share to rise from 12% to 29% over the same period. These increases are at the expense of declining shares in the NMC 532 and 622 chemistry, the most popular chemistries today. China has been a long proponent of LFPs. The commercialization of second-generation LFP technology will enable application in vehicles offering mid or even high drive range. We also expect the LFP uptake in ex-China markets to rise, led by increasing application in entry-level models. And this demand will be met by imports, particularly before battery capacity investments in ex-China markets materialize into local production. The PEV segment will be the dominant demand driver for lithium, cobalt, and nickel. We forecast lithium to experience the highest demand growth among the 3 battery metals. Its market volume will nearly triple to over 1 million tons of LCE by 2025. This is thanks to a high passenger PEV demand share today, and that the lithium consumption intensity is relatively stable across the different chemistry types. Nickel is the largest battery metal by overall market size, but PEVs only accounted for 4% of demand in 2020, with the vast majority used in the stainless steel sector. So total nickel demand is forecast to experience the slowest growth rate, lower than cobalt, despite rising nickel intensity in batteries. We still forecast total cobalt demand to rise by nearly 80% over the next 5 years, as higher PEV sales offset the impact of cobalt thrifting in batteries. Lithium raw material supply is concentrated in Australia and Chile, who together account for 72% of global supply today. Cobalt supply is even more concentrated. Democratic Republic of Congo accounts for 71% of global mine supply, and this share is set to rise. The global shipping bottleneck is deepening metals shortage and providing further upward price momentum. lithium exports from Chile and Port Hedland in Australia were down 2% year-over-year in October. Some companies are establishing warehouses at destination markets, which provide some buffer. China's cobalt imports from DRC rose 24% month-over-month in September. However, they were still down 38% compared with the pre-COVID level in 2019. DRC cobalt is mostly exported out of the continent via Port Durban in South Africa, and the port has suffered low handling efficiencies for the past 19 months, now exacerbated by the constraints on global shipping. Transnet, which is South Africa's port operator, is also proposing to increase the tariff by nearly 24% in the next financial year, which, if implemented, could sustain higher transport costs. We track a number of indicators on mining activity and deal flow, including annual exploration budget, monthly project drill activities, monthly financing raised for junior and intermediate mining companies, as well as M&A involving assets with resources. Looking at two of these indicators for lithium, we have seen a robust financing scene this year, especially as decarbonization and the energy transition are on top of global agendas. Lithium financing raised in the year to September is 115% higher than the full year 2020 totaling 2.29 billion. The amount of lithium acquired in reserves and resources through M&A deals more than tripled in 2020, despite the disruptions inflicted by the pandemic. In the first half of this year, 4.5 million tons was acquired, leading us to predict another increase for the full year. Robust lithium prices, coupled with a strong outlook for PEVs, are encouraging miners to accelerate project development and explorers to seek new discoveries, strengthening the lithium supply pipeline. Looking to our price forecast, lithium prices are likely to remain elevated from market tightness until at least the first half of 2022. Majority of the supply increases are scheduled to reach the market from mid next year onward, which could then ease the tightness and prices could see a degree of softening. The seaborne Asia price also has some catching up to do with prices in China. The latter yielded a 35% premium at the end of October after adjusting for VAT. We expect the annualized lithium carbonate CIF Asia price to rise 60% this year and then by 24% in 2022 to $13,679. We expect annualized lithium price to ease over 23 to 24 as the market returns to surplus, and pending deficit in 2025 to spur prices to rise back to $13,861. Cobalt prices are likely to remain supported as logistical pressures persist into the first half of 2022. But the full year average price will see a correction next year as supply chain bottlenecks normalize and from the Mutanda startup. Cobalt demand is forecast to continue growing as higher PEV sales offset the impact of cobalt thrifting in batteries. A stronger supply ramp up through to 2024 will sustain market surplus during the period, pressuring prices. We also expect the cobalt market to see a deficit in 2025, supporting the price to bounce back. You just heard our base case forecast for lithium and cobalt. We mentioned earlier, the choice of batteries is crucial in driving these metals demand growth. The battery industry is very innovative, and battery choices remain fluid, especially in the long run. A couple of months ago, we ran 2 battery chemistry scenarios to see how the 3 battery metals market could change from their base case under different assumptions. The 2 scenarios involve a complete displacement of the most popular battery types today, the NMC 532 and 622 cathodes, with either LFP or nickel-intensive batteries. The scenario outcomes suggest cobalt demand will be the most affected. In fact, cobalt demand in passenger PEVs could see a 59% drop in 2025 from the base case when assuming a high LFP scenario, and a 44% drop when assuming nickel-intensive scenario. Under these downside outcomes, the cobalt market could see a surplus instead of a deficit in 2025, with prices declining to $13 to $14 per pound, the level seen across a number of months in 2019 and 2020 amid excess supply and weak demand. And that's half of where cobalt price is at today. But the potential of the cobalt price downside is somewhat counterintuitive to the strong capital injection into the cobalt sector this year. Cobalt financing raised in Q3 is nearly 5 times the amount raised in the full year 2020. Glencore is restarting its Mutanda operation this year. They are processing from stockpiles in preparation for a full ramp up next year. In Q3, China Moly confirmed plans to more than double capacity at its Tenke operation. We conducted a deep dive analysis into mine costs and modeled cash flows and margins, assuming cobalt prices do drop to $14 per pound under the downside scenario. And the outcomes suggest that copper cobalt mines will remain profitable, although margins will narrow. For large expanding mines, the impact of the lower cobalt price is somewhat limited, as lower unit margin could be compensated by higher copper production. In all, we forecast lithium prices to remain strong in 2022 as a result of ongoing market deficit. The full year cobalt price will see a correction next year as logistical bottlenecks ease and supply rises. There has been a surge in lithium and cobalt financing raised this year, supported by strong prices and positive PEV outlook in the long term, as well as growing interest among producers to include lithium and cobalt assets in their portfolios. The uptake of nickel-intensive and LFP batteries will reduce cobalt intensity, but copper cobalt mines will remain profitable even under the downside price scenario, supporting expansions in these projects. You can access more of our research via the link here. Feel free to drop me a message via the conference chat function or through this email address. I hope there'll be the chance to attend and see everyone in person next year. Thank you.